What's up, you guys? So if you are in a real estate deal that's struggling right now, maybe distributions are paused, capital has been called, or the refinance hasn't worked out the way that it was promised, I want to start by saying that most likely your building is not the problem. I'm sure the tenants are paying, the neighborhood's still fine, and the location makes sense. What most likely has broken is your debt. That distinction between a real estate problem and a debt problem is going to determine who makes money over the next few years and who doesn't. That's what this video is all about. I want to walk you through something most passive investors never get told cleanly. I'll be upfront with you. This is something that I had myself completely wrong for a lot longer than I want to admit. Now, I've made over 100 investments in real estate since 2014 as an LP, as a GP, across markets, across different structures. And some of the beliefs that I'm going to share with you, the limiting beliefs, mind you, I've held for years before the market corrected me and before my own independent analyses have really kind of allowed me to challenge myself to be a better investor. And I want to share that with you. So this is not going to be a lecture. It's kind of more like, here's what I've learned the expensive way so that maybe you don't have to, but I hope you find these useful. Here's a chart that I want you to look at for a second. The blue line is the Federal Reserve's rate, and you could see it coming down. They cut 175 basis points starting in September 24 all the way through December 2025. Now that's a huge move if you track rates, right? But the green line, that's the 10-year Treasury rate. Notice anything here? The green line didn't follow the blue one down. It actually went up from 3.72% in February 2024 to 4.14% in December 2025. So the Fed is cutting and the other rate is going the complete opposite direction. And this is why this matters for you as a real estate investor. Because when you get a fixed rate loan from Fannie Mae or Freddie Mac, which is what most apartment deals use for long-term financing, your rate is not set by the Fed. It's set by the 10-year Treasury, plus whatever the lender adds on top of that. Usually it's like 2%. The Fed is mainly for, that rate is for overnight lending between banks. So it's not your rate. Your 10-year loan, apartment loan or your 5-year loan lives in a completely different market. And these two rates can and do move in completely different directions. So the MBA, which is the main research body for commercial real estate lending, confirmed exactly this in February 2026. Their chief economist said, and I'm going to read this directly so you have the quote, but while the Federal Reserve cut its short-term interest rate by 100 basis points in 2024, longer-term interest rates increased over the same period by an equivalent amount. Commercial property owners who sought to take advantage of a drop in rates stemming from Fed cuts were disappointed. That's not me editorializing. That's the industry's own chief economist describing what actually happened to people that were waiting on the Fed to cut rates. I want to share 4 things that I used to genuinely believe about real estate investing, and I hope you find these valuable. But these are things that for me felt completely logical at the time. I've been doing all these, different deals since 2014. I should have probably figured out sooner, but I didn't. And I want to be straight with you about that. At least one of these is going to land, if not, several of them, for maybe what you're looking at and how you're evaluating deals today, whether you're passively investing or actively operating real estate. Belief number 1, I used to believe that when the Fed cuts rates, my borrowing costs go down. Seems super obvious and logical, right? The Fed moves, everything moves with it. I held this so confidently enough that when the Fed started cutting in late 24, I watched and waited also for financing costs to follow, and they didn't, at least not meaningfully. And that's when I actually went and looked at how a Fannie Mae loan gets priced. And it turns out, like I said, follows the 10-year Treasury, totally different market. And the Fed, despite it cutting aggressively, was actually being met with the loan prices that we care about going the complete opposite direction. So I was watching the wrong number. And it cost me time that I could have spent underwriting real deals in that market, 100 investments in, and I still had to learn this one the hard way. We know this now. We know that these are totally different markets and that they trigger in totally different points. But when we start to combine this together with belief number 2, I think you can really start to build a good, strong thesis here. Belief number 2 is that I used to think that waiting was the responsible move, that patience was discipline, the best deals come with time. A smart investor waits for more clarity before deploying capital. Sounds, fairly reasonable, right? But what I actually learned is that patience and waiting are not the same thing. Patience means underwriting carefully and moving when the numbers work, even when rate cuts might be looming and we don't know yet which direction the 10-year is going to break. Now, waiting means sitting on the sidelines until it feels comfortable. And in a transitioning market like we're in today, comfortable usually means you've missed the entry until things have actually been priced in. Now, the clearest deals that I've seen in the last 18 months went to buyers who are ready to move before the consensus formed. That's where the alpha is in today's market. And by the time it feels safe, typically that's already reflected in the price. So I've done both of these things. I've been the guy who moved early on good numbers. I've also been the guy that waited too long for the all clear that never came. I mean, one of the best exits we've had, we actually just had this recently, was aggressively buying multifamily in a key Midwestern city right at the onset of COVID. A lot of buyers were scared, buyer demand dried up, and this is before money printing became such a thing. But we started buying, apartment buildings, pennies on the dollar, and have since turned that into a fund that returned just a ton of capital to investors at this point in the cycle, mind you. Sometimes waiting is not your best friend, but taking action when the numbers work do. And I can say that from experience. Now, belief number 3. I used to believe that a high rate environment was just kind of a bad environment for real estate. Full stop, right? Rates up, deals don't pencil, sit it out and kind of wait for them to come down, wait for better conditions. What I understand now is that high rates don't kill good deals. They really just expose bad ones. So a deal that generates cash flow today at today's borrowing cost is actually a better deal than one that only worked at 3 or 4% interest rates, because it doesn't need anything to go right. If rates improve later, I mean, great, that's upside. But if they stay flat and nothing changes in the hold period, the deal still works, right? And that margin of safety didn't really exist for most 2021 and 2022 vintage deals. It sure does today. Now, I used to see a high rate environment as the obstacle, right? Now I actually look at it as a filter to filter away the crappy deals. And it's a pretty effective and good one at doing that. Belief 4. Now, I used to love distressed real estate. Operational value add. I mean, that was my lane, right? Finding a building that was mismanaged, underpricing the heck out of it, and sort of giving a lowball offer to ultimately show that we're going to come in and fix the operations, force appreciation, make our investors a lot of money. I understood that. I've done it. I like the strategy. And then the market turned. And I watched smart and experienced people all around me get absolutely torched that do this strategy. And it wasn't because they couldn't operate. It's because the debt that they had didn't survive the rate environment. And the buildings, even though they were genuinely improving with occupancy and rents growing from what they had, just kind of froze. So the operators then got wiped out and the investors got stuck in a pickle. And that's kind of the situation we're in now as new supply comes online, which looks better generally than the older stuff that everyone was fixing up. And so I had to ask myself, into 2026 and even last year, the year before, what kind of distress am I actually chasing? Because there are two totally different types of distress that all lump on the same nomenclature here. So one is operational distress. This is buildings that have real problems, maybe bad management, high vacancy, deferred maintenance. You're basically buying the mess and you're getting paid to clean it up. And it takes time and skill, and perhaps most importantly, a market that actually works with you to make sure that you can make that work happen. Now, financial distress is totally different. That's where the building's fine, the tenants are paying, the neighborhood's fine, but the loan is killing the operator's ability to keep the asset. So the capital structure is the problem, not the real estate itself. Now, Howard Marks of Oak Tree Capital wrote about this in his book, Mastering the Market Cycle. I love this book. You guys should read it. But he talks about how in real estate, it's often the third owner that makes the lion's share of the money. That is the one that comes in after there's a capital reset moment, after people bought at peak optimism on the cheap debt realities that they had to face. And here's how that maps to right now, because the story isn't about, brand new buildings coming online. It's about the value add playbook that everybody was running in 2019, 2020, 21, 22. That strategy made a ton of sense at the time. You could buy an apartment building, an older class, maybe something that's workforce housing from the 70s, 80s, or 90s. You renovate it, push it to market rents, stabilize and get occupancy, and then turn around and refinance your short-term acquisition loan into something that's longer term once the property's performing. Now, it's a clean exit from the bridge into permanent debt at a good rate, and that gets investors happy. And to fund that acquisition and the renovation costs, operators used short-term floating rate bridge loans. These are, 2 or 3 year loans, and the rates were, decently low, so the math works pretty well. Then, of course, rates doubled, and the permanent loan that they plan to refinance now costs 6.5% or 7%. The math totally stopped working, and they couldn't exit the bridge. So most of them have kind of played this extend and pretend game once, sometimes twice, where the bank will push their duration out a little bit, hoping that rates would fall back and allow them to refinance. But they haven't meaningfully done that. So those extended loans are now hitting their final maturity in 2025 and 26. The lenders are done playing that game, and the choice is really refinance at painful terms, bring new capital in, or sell probably at a loss. That's the motivated seller. Not someone who made, bad real estate decisions, but somebody who made a reasonable bet on the rate environment and it didn't work out. The building itself is fine, the tenants are paying, the neighborhood's still good, but the loan is the problem. The third owner buys that building now. It's the same assets, the same tenants, same location, but it's priced for what it's actually worth today at today's rents with today's borrowing costs with no rate rescue built in. Now you might be thinking, wait, if this all started in 2022 when rates spiked, aren't we already past that opportunity? Not quite, and this is important. Because through 23 and 24, most of those operators didn't sell, they extended, right? So it's kind of like a slow creative destruction. And lenders cooperated because they didn't want to realize those losses either. So the industry calls that extend and pretend. And it bought time, but it didn't fix the math. That debt is still there, the rates are still high, and those extended loans are now hitting their final maturity with the banks that aren't really willing to play ball anymore. Now, the MBA says that there's $875 billion in commercial loans that mature this year, of which $162 billion is in the apartment space. So that's a huge chunk of extend and pretend deals that are finally running out of road. That's why the window is now and not 2 or 3 years ago. And I want to be honest, it's not like a tsunami, but the distress is real and it's specific. Not every building is in trouble, but it's the ones with the wrong debt structure bought at the wrong moment in the markets where new supply also came online and suppressed the rent growth due to competition. So the buildings themselves are often fine, but the capital structure is not. That's exactly what we're focused on today. It's not necessarily the operational messes that need years to fix. We really pivoted from that model, and it's really more looking at financially distressed assets, those healthy buildings at reset prices where the only thing that broke was the loan. Now, the operator who bought in 21 needed rates to stay low, rents to grow, and ultimately the refi to work on their schedule. They needed everything to go right. We don't. We're buying at numbers that already reflect today's reality, and that's the third owner position, according to Howard Marks. 2026 is the year when that window is open. Now, I published a whole piece last week on exactly how this debt math plays out, the numbers, capital call scenario, you should check it out. But the short version for now is that $162 billion of loans mature in 2026. Now, most of them are the extend and pretend type situations that I already described, where the building is fine, but the loans are broken. That's the supply of motivated sellers and assets that will ultimately make us money, whether the Fed cuts or not. And that's what makes this moment different. It's not rate driven, it's math driven. So here's how we approach it at Ocean Ridge Capital. Every deal we evaluate gets underwritten today at today's cost of borrowing, not with like a rate rescue or not with magical refinance 2 years from now that's 2% less than what we have today. If the deal works at today's numbers, we look at it harder, and if it doesn't, we pass. It's pretty simple. Now, to make this concrete, here's what rate improvement actually buys you in real dollars. Standard Fannie loan today runs roughly 6.1 to 6.5%. And if rates improve 50 basis points, which requires the 10-year Treasury to drop meaningfully from where it is right now, $80,000 of debt per unit, you save about $33 per unit per month. On a 50-unit building, that's about $1,600 a month. Real money, I'm not dismissing it, but it's not what rescues a deal built on a rate forecast. If a deal needs a rate cut to generate cash flow, you're not underwriting a real estate investment, you're making a bet on interest rates. And there's nothing wrong with making directional bets, just know what game you're playing. want to leave you with one question. And this is the one question I want you to carry into every real estate investment you look at in 2026 and 2027. It's that, does this deal work at today's loan rate? Call it conservatively 6.5% for standard agency debt with zero other help from the Fed. If it underwrites with conservative assumptions, you might have something real. And if it doesn't, you might not be evaluating a deal at all. You might just be evaluating a forecast. Know which one you're doing before you write a check.